Hello and welcome to Your Business, Your Wealth. I'm Cory Shepard, president of Sound Financial Group and co-host of this show. It's going to be just me for a little bit here at the beginning, different kind of episode. I'm going to give you an intro and then hand it over to Paul. Uh, I don't think we've shared with a lot of you how we first got together. I had a very unique journey in joining forces with Paul. It started with a random connection on LinkedIn. In fact, I thought I was recruiting him. He was trying to get me to join him in the other direction. So we had a few minutes of working out that conversation at the beginning of our first coffee. And I was on the leadership team of a major traditional planning organization and really happy where I was. So I said, hey, thanks, but no thanks. And I see that you're clearly not looking to move anywhere either. So maybe we don't need to keep talking. And Paul just said, oh, let's just keep having a set of conversations. Let's just keep chatting about different things about the industry. We're two professionals there. And so we had a series of friendly conversations around a few different things that then friendly turned into serious when he helped me discover some financial elements I wasn't caring for my own family, let alone my clients. And I realized that where I was while I had been happy was leaving me grossly underprotected and underserved, and thus was likely leaving many, many of our clients in the same way. So it quickly became a moral imperative for me to not be where I was. As happy as I was being there, I just couldn't do it anymore. And joined forces with Paul to start a journey towards telling our clients the whole story about what's going on with their money. And so he's going to lead you through the first piece of a set of conversations we had together when we first started talking. Today, part one of the illusions of investing around stock picking and survivorship bias in the market and how folks are looking at completely the wrong set of data when they're making their financial decisions. So with that, I'll turn it over to Paul.
Well, for all of you listening, you may wonder, when somebody gets in the financial business, what do they do? What do those early stages look like, and who influences them the most? Well, my story started at the age of 18. I joined a major financial firm as an internship, but the internship was really an opportunity to start building a book of business. This company has a lot of turnover in their early internships, which leaves them kind of inheriting a lot of clients. But at the same time, some of those folks broach out and become quite successful advisors. So I had a chance to meet with a wholesaler with a mutual fund company. So think like pharmaceutical rep that goes and meets with doctors and says, this is why you should prescribe our medication. Except for the financial business, when it's mutual funds, they begin to go around and say, here's why you would want to take time and introduce our mutual funds to your clients. Now, early on, that was wonderful to me. I was 18 years old. I was enormously overweight, meaning I could put away the groceries. Like at that time, I weighed about 240 some pounds, and I was not a foot taller. And this gentleman said, well, why don't we go, we'll have lunch at Denny's, which was nearby the office at that time. We're just going to talk. I'll share with you a little bit about mutual funds, educate you, etc. And I was like, oh, that'd be great. Sure enough, spent some time going back and forth. I learned a lot. And at the end of lunch, because my parents raised me right, I had just learned a lot. So of course I should buy lunch. I go to take out my credit card to pay. And he says, no, I got this. I say, you can't buy me lunch. You've just gone through and spent all this time educating me. It's the least I could do. He says, it's okay. The company pays for it. It's part of what I do. And of course, I was a little bit of a neophyte. I was 18 years old. I didn't know. So it sounded pretty good to me. And those lunches at Denny's for that educational experience became lunch at P.F. Chang's, became dinner at P.F. Chang's, became dinner at Roy's or Ruth Chris. You see, over the years, the mutual fund companies have this entire sales model where they go out and share the story of their investments. Or, as you guys are going to learn through this set of talks, you also learn about survivorship bias and that some stocks get shut down. Those stock mutual funds get shut down when they have bad returns, and the returns go away. But I didn't know any of this because where was all my education coming from? That mutual fund complex. And that's the case for many advisors in their early career, and some of them decades and decades into their career. Because those dinners also became quote unquote due diligence trips to the Ritz-Carlton. And it wasn't until after years of being exposed only to mutual fund companies' education about mutual funds that I tripped over some academic data. And when I tripped over the academic data, it was reading a book called Unconventional Success. It is a very dry read. I don't recommend it to people. But what this gentleman talked about, he was the manager of the Yale Endowment, and he started to talk about all the things individual investors should do to be able to manage money the same way the endowments do. And then he discovered partway through writing the book that there's no way they could do it with the kinds of barriers that are put between them and the mutual funds. So what we're going to cover throughout this series is all of the illusions that got exposed as we dove into the academic data, as we dove into the people that are worried about getting the statistics and the financial models right. They're not worried about pitching a particular mutual fund. We call all of that the illusions of investing. And those illusions we're going to go over. Then we're going to talk a little bit about the independent scholarship of investing. And then in our last of the series, we're going to cover what can you actually do about it. So with that, let's just talk about what is an illusion. An illusion is something that deceives by producing a false or misleading impression of reality. You know, like a mirage in the middle of a desert, that mirage looks real, but it's an illusion. Now, some of the main illusions we're going to cover in this series are stock picking, that the myth being that somebody can pick stocks and outperform the marketplace. Number 2 is track record investing, that if a mutual fund manager did well in the past, they're probably going to do well in the future. Third is market timing. Can I get in and out of the market at a time that's actually going to serve me and my family and my portfolio? The costs of investing, as well as letting somebody else handle the money, like just delegating to somebody else, whether that's your spouse or some advisor where you're no longer taking an active role in it and some of the dangers around it. But first, let's just tackle that illusion of stock picking. Okay. That is the illusion that someone can choose stocks with a belief that those stocks are going to do well in the future. The illusion is that the investment advisors, whether that's an individual advisor or the head of some mutual fund company, can consistently or predictably outperform the market based upon their knowledge and selecting individual securities. And to start laying this out for all of you, what I think is easiest to do is we're just going to rewind the tape back to an event most of us are familiar with, which is the Allied eventual victory in World War II. Now, when we've got a room full of people, and some people are buffs a little bit on World War II and know a lot about it, we'll have people raise their hand about where was World War II won. And it's often that we'll hear things like it was the Pacific Theater or Battle of the Bulge, or it was the Allies' press into Europe on a particular date, you know, D-Day, all that. All of that is appropriate. There's nothing wrong with it, except it's incomplete. Because what I want to offer is that a huge part of World War II may have been won in a small smoke-filled apartment in Harlem, New York, populated by mathematicians. You see, these folks that were in this room would get a bunch of data sent to them by the generals out in the field. And those generals would send things like scatter graphs. So for those of you listening, right now I've got up on screen this aircraft with a whole bunch of bullet holes in it. And they would send this back to this team of mathematicians, and their job was, we need to figure out where these planes are being hit. We need to armor them more effectively. And then we also need to know how much less in payload, meaning what can they carry in terms of bombardment capacity on the enemy and fuel load. Because long-range bombing was one of our huge advantages in World War II. And the mathematicians worked everything up, and they were about to send it out the door. And right when they were going to send it out the door, what happened? Another mathematician stopped it who wasn't working directly on that project because he saw the data leaving. And he said, stop, we can't send that to the generals. And of course, all the other mathematicians are like, why would we not do that? The gentleman's name was Abraham Wald. And he said, you're studying the wrong aircraft. So what do you mean? These are the aircraft that they sent us all the bullet holes of. Why would we now say we're studying the wrong aircraft? He said, you're studying the aircraft that returned after delivering their payload. those are not the ones we have to worry about. The ones we have to worry about are the ones that didn't make it, that you don't have the bullet holes for. Now, for those of you watching our show, you're going to notice on this graph that there's some key areas that never got impacted by those bullet holes. And that is the engines, the cockpit, and a particular weak part of the wing. Now, when people see this second picture, they suddenly go, well, of course we were studying the wrong aircraft. They corrected it. They only put additional armor on specific areas of the aircraft, allowing them to still have their long-range bombing capacity and be able to deliver enormous payloads on the enemy, which I think may have governed the tide of World War II. And many economists lean toward this idea that later was further laid out by Abraham Wald of survivorship bias. That is, that one of the things that happens for all of us is we go down the road, say in business or life, and we're only looking at the survivors. And then we underestimate the amount of risk on the other side of the equation. A simple one would be, look at all of you as business owners listening, that we know that most businesses are not successful. But you're not present to that every day because every other business owner you're around is successful. They live in your neighborhood, they go to your church, all of those things. And the people who have some sort of enormous business failure regularly drop out of the community of other business owners because they have to go get a job or do something else. So all that to say that we have to be careful of this idea of survivorship bias. Okay, Paul, that's all well and good. What does that have to do with investing? Well, it has to do with how the mutual fund companies manage and guard their data, especially the data they release to the general public. So let's just look at how many mutual funds have existed when they first were incepted back in 1923. Hey everybody, I'm interrupting our show for a really important reason. We have a brand new white paper we're hoping you'll get value out of. Some of you actually might not even need the white paper. You might be ready to talk with Cory or I or our other team members about our philosophy. We'd be honored to do that with you, and it's in your control as to whether or not after that you would want to apply to become a client. We just want to impart more knowledge to you and make you better equipped to deal with the financial institutions and every offer that comes at you. But in the meanwhile, we also have this white paper that we want to give you, get in your hands to help be able to shift the way that you think about money. This white paper is going to show you 3 of the biggest mistakes we see people make and 6 ways to fix those mistakes to get you and your family on the most efficient track toward financial independence possible. You can get that by emailing us at info@sfgwa.com. That's info@sfgwa.com. And we'll look forward to hearing from you soon. We'll get it right out to you. We hope you read it. We hope it opens up your mind and puts you in a position to better be able to design and build a good life. Now back to our show. If we go back, we see there was one mutual fund that was the First Bank of Boston, now known as MFS or Massachusetts Financial Services. They had one mutual fund all the way back in 1923, and this began the democratization of individuals' ability to build diversified portfolios. Prior to this, you just went to a stockbroker and you bought some stocks. That was it. And over time, you see year over year over year, the mutual fund universe building. Now, to a great degree, mutual funds were only added all the way up through 1961, where now there were 273 funds. And that was our first extinction level event in the mutual fund industry, where 33 funds were killed. Now, over time, we have a total of 32,000 mutual funds. That's more than the stocks that they invest in, meaning there are less stocks for mutual funds to invest in than there are mutual funds. And we now have nearly double the amount of mutual funds that have been opened to those that are still left alive. And if we look at like recent years, like 2016, 2,100 funds were killed off by the industry that year, meaning all the mutual funds left standing are not all the mutual funds that have ever existed. Why does this matter? Well, I want you to think about it. Let's say we had 2 mutual funds, and it was the mid-cap super successful mutual fund and the mid-cap we plan on doing pretty good mutual fund. Now, those 2 funds matched up next to each other over a 3-year period. One returned negative 10% 3 years running because of the stocks they picked, and the other one did positive 10% a year for 3 years running. Now, if the mutual fund company needs to shut down one of those funds, which one do they shut down? Of course, they shut down the fund that didn't do as well. But the next question is, when they shut that fund down, do they send you your money back? No. In fact, if you've been investing for any period of time, you've probably gotten one of these letters that says something to the effect of, here at Great Big Mutual Fund Company, we have realized that we have two of these funds that are both mid-cap funds with very similar management philosophy, and to take advantage of our economies of scale and make it more efficient for our investors, what we're going to do is combine those two funds. And they roll the fund that has not done as well into the fund that has done much better. Well, okay, Paul, why does that matter? Well, in this thought experiment with me, just consider what would seem like the right thing to do. One mutual fund went up 10% a year for 3 years, and one went down 10% a year for 3 years, and they combined them. What do you kind of feel like they ought to do? Well, you would think that what they would do is some sort of averaging between the two, but they don't. What they do is they throw out all the negative returns of the fund that didn't do as well when they roll it into the new one. This is no exaggeration. This is not hyperbole. It's just the facts of the matter of how it works. So if you were in the fund that did negative 10% a year for 3 years, it got rolled into the fund that did well the prior 3 years. Literally, the next set of statements you get are going to give the 3-year history of the fund you got rolled into. And your results are erased. Now, they're not erased from your account value, but they're erased from the history books for that mutual fund company. So if you've ever seen the mutual fund ads that say, 75% of our funds beat their Lipper average, it should say 75% of the funds we let survive beat their Lipper average. Now, how big of a deal is this? Well, I alluded to it a moment ago, but total number of mutual funds that have ever been opened as of the end of 2017 is a total of 64,153, meaning they killed off 31,136, leaving just 32,000 funds. I think when we get our data closing out 2018, we're going to find that the dead mutual funds now outnumber the amount of mutual funds that are still around. Now, how does that affect our investment performance? Well, if you took the worst 200 mutual funds out of that group, the return is negative 81.7%. Now, negative 81% on investor money for the worst 200 mutual funds closed seems pretty bad, except it's not even in the data when you're assessing that mutual fund manager or the mutual fund family. It's a little bit like if your child is at college and they've taken a full load and you check in with them around midterms and they're failing 2 of the classes. And you're like, oh man, you really got to step this up. We're paying a lot for college. You can't be goofing around like this. I say, okay, I'm going to try harder. And at the end of the semester, they come back and you say, how'd your grades turn out? I said, straight A's. Straight A's. You were failing 2 of the classes. How'd you turn that around? He says, oh, easy. I just dropped those classes. Now that is an effective way to use survivorship bias. Unfortunately, just like the parent, while the results are erased, the costs are not. We still have the cost as individual investors across the spectrum of American investors. We incur the cost while the mutual fund families get a chance to say how well they're doing on the funds that are left surviving. So let's look at how big the actual impact is to an investor. The chart we're looking at now, if you're watching our show on YouTube, is you're going to see it starts with $100,000 of invested money. And we're going to assess how did it do if you just put it in the market. If you just chose like an index to put your money into, and we're using for this the S&P 500 and one of the funds or indexes that are out of the University of Chicago Center for Research and Securities Pricing, or CRSP index. Now, if you just invested your money, had no active management whatsoever, your $100,000, this is without the impingement of any taxes, etc., it would have been 8.6 million and 8.9 million respectively between the S&P 500 and the CRSP index. All that to say, no management intervention, over $8 million. But if we corrected for the survivorship bias, still allowing the mutual fund companies to move our money from one fund to the other and then taking the future returns of the new fund, but we leave in the negative returns on average across all mutual fund families since 1972, and we have a very different outcome. of 4.1 million. What does that mean? It means we lost a lot of money to active stock picking and management. A total of $4.8 million of lost wealth. $4.8 million is more than most families are going to have in capital at work when they get to old age. And that's just the impact of somebody trying to actively pick stocks. That what they would do is they're going to look at the marketplace, a marketplace that adjusts to new information incredibly quickly, and they're going to try to pick stocks ahead of it. Now, here's a little bit of a secret to the story. If you're thinking about investing in the market, you encounter two different narratives. One is the active stock picking mutual fund management or firm that believes in that active mutual fund management, like one of the big box financial retailers who comes out and says, we can do a better job of managing your money. And when they say we can do a better job of managing your money, they're saying because we can outperform the market. And then on the other side of the scale, you have things like E-Trade or Scottrade. And what they're saying is you can beat the market. Now, we normally treat those people as they're on two different sides of the same issue. What I want to offer to all of you is they're not on different sides of the same issue. They're actually agreeing with each other fundamentally, which is somebody can outperform the market. The big box financial retailers are saying you can't do it, we can. And all of the direct trading platforms from Scottrade to Robinhood to E-Trade are all saying you can do it. But they're both fundamentally saying the same thing. Somebody can outperform the market. And the data is absolutely overwhelming that individuals and even the best of the best asset managers making tens of millions of dollars a year cannot outperform the market on any consistent or predictable data. So as we get ready to go into our next episode, which we're going to deal with track record investing, where it's easy to say to yourself, I'm just going to pick an asset manager that did really well over the last 5 to 10 years. And we're going to show you the actual data around that ends up being another illusion that fools us into perhaps making poor decisions as it relates to who we're going to have manage our money. But I want to also give all of you a reminder. Take some time. If you haven't reviewed the podcast, go to our main page on iTunes or Stitcher if you listen there, and go all the way to the bottom and you're going to see write a review. Give it 5 stars. It's going to give you an opportunity to any amount of stars you want, just an honest review. But hit the stars rating, then it's going to give you an opportunity to write a review. It does make a difference. It changes the SEO inside of iTunes or Stitcher and allows more people to have the opportunity to come across our content to make a difference for them. Also, take this episode and get somebody's attention. Send them a text message. Say you want to have coffee to talk about this episode, because it does make a difference for us to talk about money among our friends, family, peers, and allows us to make better decisions over time simply because we're talking about it. So with that, we hope that you take the time, send the episode to somebody else, give us a rating on iTunes, honest rating, send us a screenshot. We've got a little gift for you for whatever honest rating you give us. And we hope here at Sound Financial Group in Your Business, Your Wealth, that this has been a contribution to you being able to design and build a good life. Hey everyone, thanks for watching. Be sure to subscribe, ring that bell, and when you get a moment, pick up my book on Amazon, Sound Financial Advice. It's the kind of book that's easy to read, but hard to forget all the knowledge you learned.